there's a few things we need to get out of the way before we begin anything here, and that's to put this whole move in context of what's happening here. Someone had asked here why the sudden move down, and the truth is that this move isn't all that sudden. I guess the result of the move is kind of sudden. Things tend to break quickly, but the lead up to this has been, I think, pretty well telegraphed from at least from what I've been discussing. Now, I wrote a couple of articles that discuss the Fed and some of the risks that I see in the future for the markets, and the big one I had said I thought was deflation and possible recession. Now, I've been saying that the GDP has been stall speed for a while. I've been saying that the labor participation rate is not good. It's the lowest since 1978. I've been also discussing the weak durable goods orders that are manufactured. It's big manufacturing for those of you that don't know, and the only thing that's been kind of holding that up has been Boeing. And I've also been talking about the shock risk of a slowing global economy. I think that one of the things that has held the economy, the world economies, the global economies back for so long has been, up until recently, the high price of energy. And the U.S. has sort of been spared by that due to some technological advances in horizontal drilling and hydraulic fracturing. And that has enabled us to have our own supply of energy of late. The European countries, for the most part, don't really have this, and neither does Asia. There has been a very quick contraction in the Asian stock markets that we've been hearing about on TV for the last few weeks, and they have been basically a paramount of a crash. If you take a look at the FXI never made it back up to the 2007 peak, but it did make it up kind of quite high into the 50s, and now it's back down into the 30s. It had been just sort of chopping for a while, and the officials in China decided to kind of tinker with their markets and try and do what they could to get their stock market higher, and it worked fairly well. They were up 30% last year, and I believe that it kind of became a bit of a casino over there. A lot of people are kind of trying to equate it to the crash here from the 2008 and 9. I would say that the crash in China is probably more akin to 1929. And the reason I say that is because there was sort of this euphoria in stocks. They had what looked like gambling booths practically set up in their brokerage offices. People actually went to their brokerage offices to trade. That's sort of how it was done back in the day. And I think that they're just going through a massive correction. Where that ends is a little bit iffy. I'm looking at the FXI chart now, and it's through the primary trend, and it's roughly hugging close. Today we didn't quite touch it, but close to the 61.8% fib of the move. So I actually do believe that there should be some stability, at least for a tradable bounce, sometime in the next maybe couple to few points in China. There are some reference lows between 2861 and where we are here, believe it or not. So it wouldn't shock me to see some type of a bounce, but their fundamentals there are not strong. I've also been discussing the crash in commodities, and I'm not afraid to use that word. They seem to be afraid of it on TV, but that's really what's been going on. You've had crude oil peaked at 147 in the I guess in the 2008 bull market for energy, and it has most recently peaked at about $114 a few years ago. I think this was 2011, and since then it's been kind of banging its head up against 110. And like I said, we've had some real amazing energy advances, and it's enabled us to have an increase in supply. The Saudi government has decided and taken it upon themselves that they want to get rid of their competition, sort of like Michael Corleone style. And the way they're doing that is they're flooding the markets with cheap crude, and they are looking to put some of their competition out of business, and it is working. I think that there's a little bit more to it than just that. I think that there is also demand destruction. I believe that like I said, the global economy has been very weak, and things are slowing drastically, and there is less of a consumption for oil, for petro. So that leaves us with, where does oil bottom? There's a lot of people who were talking about $20, about where it had bottomed in the 1990s. I mean, I guess it's possible. Anything's possible. But we also have increased the world population. Global consumption is higher than it was back then. And I don't necessarily know if we see back there. I've been talking about somewhere between 37 and 33.20 being the 33.20 was the reference crash low from 2008 and 9. So it wouldn't shock me to see it a little bit lower, to a pullback into that area. Now, one of the issues also that has been weighing on these commodities has been the strong dollar. Now, why is the dollar so strong? Well, as these countries are putting in, I guess, capital constraints, and as the world, I guess, worries about what to do with their money, they flee it into the most deep and liquid market, where I guess where they believe they can get a return of their money, not so much on their money, and that would be the United States. So what they do is they convert their currencies into dollars, and then they use those dollars to buy treasuries, and that's why the treasury bonds have been stronger. So that is one reason for the dollar strength. There's also been I guess, I'm trying to think of a word to describe it, but I would say the bluff by the Fed now at this point to try and convince people that interest rates would increase. It's funny, all of the TV talking heads talk about interest rates increasing, and they say, oh, the Fed's going to do it just to do it. You know, it's a quarter of a point, it's nothing. That isn't the case. The reason why the quarter of a point would be so devastating isn't because of the size of the increase. It would signal a shift in policy, monetary policy, and this would be coming at a time of deflation. The Fed should be more afraid, and what has been weighing large on the Fed's psyche is the 1937 experience. I know a lot of you don't know what that means. I have done a lot of studying on monetary policy, as well as global. I guess the 1929 crash. It's sort of been a phenomena that has always interested me. I've read a bunch of books on it, and back then, what caused the 1929 crash? You know, nobody really has put their finger on it for certain. We were definitely more of a domestic economy back then than we are now with manufacturing. And that isn't the case anymore. All of that manufacturing has gone to the Asian markets. But it was accredited to an inventory recession. Now, I've also heard it argued by some of these smarty pants economists that it was also from undercapacity utilization. And that's really just semantics, because both are the same side of the same coin. Now, I don't really know if that's going to be what causes the quote-unquote recession here, but I will tell you, just from just opening my eyes and seeing what's happening, is there, and it was acknowledged in Chair Yellen's last Fed speech. I had mentioned all of this. I have an article. I'm going to post a link on Twitter later after the broadcast, and it's also going to be in the rebroadcast of this on YouTube. And it's basically the Fed's new lower for longer lifestyle. Kind of catchy article. It covers all of my Fed analysis quite well, I think. And if you want to kind of catch up on what's going on, do yourself a favor and read it. It won't take you that long, maybe 10 minutes or less. I think it'll explain a lot of this stuff to you. But there is what I believe to be structural unemployment as opposed to cyclical. Now, what does that mean? Cyclical unemployment means it goes up and down with the economic flows. And this basically means that technology in this instance has started to block out jobs that would be normally taken by people. We've had tremendous advances in automation. Like, for example, I was at the movies the other night, and afterward there weren't that many restaurants open, and there happened to be a pizzeria Uno. Not really particularly great food, but hey, they were open. And at the table there was a iPad-like device, and I was able to either order appetizers or drinks right off there without a human being. And they weren't quite up to entrees yet, but the manager had assured me that that would be coming. I usually eat in, I guess, nicer establishments than that haven't quite automated yet. But this is the future. This is what is happening. And these are all low-paying jobs and wages, and that's why you're starting to see this social unrest in places like Ferguson and in Baltimore, because you have very poor people who are out of work, and they have no other, I guess, choice but to kind of riot, so to speak. Anyway, that's the backdrop of what I'm seeing. I have thought that the economy is a lot weaker than people realize, and this whole nonsense discussion about raising interest rates was not going to be the case. I believe a couple of banks came out today and said that they thought that this was going to happen in maybe even 2016. I don't want to get ahead of my skis here and sort of make the call that it won't be 2016. But if the market continues on the way it is, it might not even be 2016. There was a leaked Fed document that said that they were going to normalize their interest rates at 3.5% by about 2018, which is stunningly low interest rates for a very long time. Anyhow, that's sort of the backdrop to what has led to where we are now. Now, why we tanked on the Fed, I guess the Fed minutes, was because we rallied initially because I think people believed that we were going to be lower for longer, but I think the reality finally has set in that earnings estimates are too high, and that there are going to have to be number cuts across the board. And I believe that would be the reason why Tim Cook came out today with his note to Cramer in the morning saying that China sales are good, because he wanted to reassure the market, I guess, that they weren't going to, cut numbers. Apple, as we all know, is the biggest company in the world. They are exceptionally well run. They have amazing supply chain management. They have very competent management. They are the best. So maybe they are going to dodge the bullet for a little while here. I will say that Apple rallied very strongly off of the lows. We're going to talk about what happened at the open in a minute. But it still closed below 105.65, which was yesterday's low, and I still believe could be vulnerable to as low as $85. I don't know if we're going to see that now. We saw a really, what should have been solid low in a lot of stocks today on some major washout action. Now, so what happened today at the open? If you're a newer trader and you haven't been around since at least 2010, I believe that's when the flash crash happened, that is what took place this morning. And I know everyone wanted to not call today a crash, and it's sort of a politically incorrect way to describe a market. But when I see a lock limit down open on the S&P futures, and I see it was down over $140 in the ES today, that to me constitutes a crash, and that is what is happening here. We are in crash mode, and when the crash ends is sort of hard to gauge, because one of the things that I would say scared me the most today was the fact that we rallied so strongly immediately, and then I would say we sold off fairly sharply. You know, when stocks get killed, they kind of need to be killed for a little longer than, the opening hour of trade. I did talk about some opportunistic trades, though, on the stream with regard to covering some shorts, and also with some premium sales when premium gets really jacked. Sometimes the market figures it's opening down 140 points. It sort of factors in that the same week maybe another 140 points are possible, and we all know that would be theoretically possible, but mathematically unlikely. So when you have situations like that, I like to try to take advantage of them. However, the problem is now is that we are down really sharply. The last few days, we've had a trend line snap from the channel low of the 2011 low, and the true primary trend line of the S&P in terms of the SPY doesn't come into play until currently close to 167s and 168s. That's significantly lower. I'm not necessarily sure that we go there immediately and it's just a complete free fall down, although believe it or not, that is very possible. But I think that there will be some type of a rally or bounce attempt. If you take a look at some stocks, like let's just arbitrarily pick one, GE for example. This was a major flash crash victim of the open. GE on Friday closed at $24.59. Today at the low, it got down to $19.37. Home Depot. The Friday close was $116.16, and the low today was $92.17. These are not biotechnology stocks. These are real companies with real balance sheets and real earnings that do not trade like this. And a few weeks ago, I had already said this on Disney, that you need to respect price action when it behaves in a fashion that it isn't accustomed to. Disney had that huge gap down, as we recall. It is now way lower than it was then, although now, believe it or not, it's starting to get into some reference ranges close to 90. Today, the low was 90 on the nose. I have some put ratios on with that. I don't mind being long Disney for a little bit here for a bounce. Let's continue on. Another one that was slaughtered with this flash crashy action was Baidu. The Friday close in this stock was $152.91. The low was $100 today. That stock was demolished at one point. I mean, these are insane moves. This is what's known as a flash crash. The problem for me, the list goes on. It's a litany of names. I think Facebook was at $72 or whatever at one point. So what can we use? Why is that information useful? So this is where the experience comes in and why you guys follow and watch me. When stocks test like that, when they go down in that magnitude, the algorithms which really control the markets, the terminators, if you will, I've often called them the terminators, that really control the market on a short-term basis, log those levels and then like to retest them. So it's very possible that the market wants to go back down and retest those levels. So that would put a lot of pressure on the indices, particularly in the S&P, and in the Dow. I'm not sure what the timetable is on that, if we want to rally more ahead of time or if we want to do it sooner than later. That's an order of operations issue, but that should be in the back of your mind, and those levels should be marked. If you get back down to them, it might be a good idea to sell some out of the money puts. Are they secure lows? Only time is going to tell. I don't necessarily know that they are. For the time being, they are. I think it's possible we could have a few days more rally before there is a resumption of the move down, but unfortunately, we have done some things technically, and I can't show you this on the charts with Periscope, but you have to take my word for it. We have broken some really, really key range levels, and we are now at the kind of range low where this run began. The bounce today took us up back pretty high. I had discussed at that level I was going to be taking off some put ratios that actually were blown through on the open today. I assure you that was not pleasant. I was a little bit concerned about them, and just from past experience, if you're able to get your money back, or you're able to get out of a bad position that you had just put on rather quickly, sometimes it behooves you to do so. I did believe they, like for example, the move, like I had on expiring this week, 4 days to expiration, the 109, 105 Apple put ratio. So that means I was long one Apple 109 put and short two of the 105s. Those were blown through today when we got down to the lows, and Apple wound up rallying back up to, I think the what was the high in Apple today? I know I was closing it in the mid 107s. I think it was basically break even. It might have been like it was either a small gain or a small loss, or it just was break even for the most part. Yeah, at 108, 108.80. So we couldn't even get to 109s, which is a little bit telling, considering 109.14 was sort of should have been a quote-unquote secure low in Apple, which we violated on Friday. I've been saying the stock was vulnerable. In my weekend video, if you take a look, and believe it or not, those levels are still very relevant. I had said I thought that this would see the 100.72 with potentials, and I went out further on Fibonacci's, talking about a 50% fib to 95 and potentially the 61.8 down at 85.72. We got really close. We got to 92 today. So I don't know if that level is going to be revisited or violated or what, but I would be an interested buyer if we could get down close to there around 85. Why would I feel comfortable there? Because Tim Cook has now came out and said that Apple earnings in China are okay and that business is accelerating there. I don't know what that necessarily will translate into in terms of Apple's earnings and the reaction of earnings. But we sort of, I am going to understand his note as a pre-announcement reaffirming guidance. He didn't firmly say that, but I think that was the implicit implication. If they miss this quarter, just so you know, after that, they are toast. That stock is going to be down so big, so bad, you don't even want to know about it. But I do believe that it might not be now, and that you have to take it at its face value, and that the earnings should be good. So Apple will go on a buy the dips list, but it has to be a dips list, not going, up, not when it's up. I'm just looking at some other stuff here that I wanted to discuss. All right, so let's talk about China. We talked about the FXI, but you really need to see China stop crashing and sort of stabilize before you can kind of, I guess, call a bottom and feel better buying the dips. A lot of people today are going to open up the newspaper tomorrow morning or turn on the nightly news tonight and hear about how the stock market was down 1,000 points, and they are going to call their brokers and they are going to sell. Or you're going to have a continuation of some margin calls. One of the things today that sent one of the biggest shivers down my spine, and I've been hearing this a few times the last few weeks, and I think I've talked about it, is they interviewed a portfolio manager. He had a nice suit on. I mean, probably not as nice as some of the ones I have, but they looked okay. And the guy basically came on and said he thinks that the market sell-off is a buying opportunity. To which the reporter rightly followed up and said, "Are you buying? Have you bought?" He said, "I would be buying, but we're fully allocated." So the people who want to buy don't have the cash raised to do it. And that is an absolute disaster. That means everyone is in and there is no money left. And if you take a look at the outflows that have been in the, I guess, the money flow chart, that isn't a good sign. I think that the market is going to go, I think it's going to go a lot lower. I don't know that we're going to see, that we're going to not see some type of a significant rally first. It's very possible. We did hold some key range lows today. We are well off with the sort of the rally high. We had gotten a little over, believe it or not, 50% back from the Fed spike. Also, I just wanted to know where the Fed spike failed. It was in the 210s, which has been a very key level. And I think once people saw the 210s couldn't hold, they were sort of out. I had been discussing, remember, that I thought the Fed range of the day of the Fed day was going to determine the rest of the year, possibly. I said the summer and maybe the rest of the year, and we are well below there. One of the things the market does have on its side is the highs aren't relatively, there's no excess on the highs, they're relatively poor. This could be a very large liquidation break. Everyone talks about how they want to see a 10. Oh, you turn on the TV talking heads, and this is probably the same genius who's fully allocated. If only the market would have a 10% pullback, I'll be a buyer. Well, that's not really what happens. When markets pull back 10%, people say, okay, let's have 15% or let's have 20%. They kind of use the hide under the desk strategy. As we know, that's troubling. So I'm just saying to be really cautious in the market. I don't think we've seen the end of it, the capitulation that everyone is so desperate to see. Markets usually don't bottom on Fridays or on Mondays. I turn on these guys. They always want to talk about 1987, so let's talk about 1987. The market there didn't bottom on Monday. It bottomed after a huge down Monday and a huge down Tuesday, and it turned intraday. That could be the scenario this time. Maybe we're down really big again tomorrow, and maybe it turns tomorrow, or after being down big, or maybe it turns after Wednesday. If there's some type of a bounce, we'll be looking to short. I would be saying at this point the rally today took us back up to the 197s, and that had been the range. There had been two range breakdowns: the 204s and the 197s. 197. What was the low here? 197.86. As many of you know, if you saw my weekend review, I had a bit of a meltdown in my charts, so I kind of had to redraw them, so I'm not as familiar with the levels here as I once was. I've sort of updated them a little bit. So it's a little disturbing that we rallied up to sort of the breakdown level and failed in SPY. I wouldn't be surprised to see if we do wind up rallying a little bit more. Maybe we could retest there. I don't think that the market is really going to be able to get back over 204 at this point. There's a lot of inventory built up there. I think that would be an amazing gift for a short if we can get up there. We'll see what happens. I'm not necessarily sure that we can or will so quickly without going down first. We filled a really big gap in the 190s. We got down to the range low. I had said in the weekend video that 181s, I thought, like almost 181.92. We got to 182.40, so it was pretty close. We'll have to see how that range is handled and if it's violated. If that does get broken, the next reference low isn't until the 173s, 173.83 really, and then the real primary trend, which is down in the 167s, 168s. I've been saying for a while, and I didn't know when this would happen, and maybe there is an overshoot, that I thought we were going to at some point retest the 2007 top, which is 157, like 157.52. I also believe I don't want to go back and look, but if memory serves me right, the 2000 top was down in the 155s. So that can happen. We could have another few waves down. It's just a matter of, this is really, I consider this wave one. So wave one is usually not the most devastating or damaging, and there's still some hope. I would be surprised if there isn't some type of a counter trend rally before we would get those sort of waves still lower. The market has been so overbought. I said it got up this time. I had said a few weeks ago, even a couple of months ago, that the 213s this time might be different because we got the 1.618 Fibonacci extension of the 2007 high to the 2009 crash low, and if you overlay a Fibonacci extension on it, we achieved that number. So, that 2007 top was sort of the breakout, and we've never come back down to retest it, so it wouldn't surprise me to retest it. That's actually amazingly healthy for a market to do. It's really a shame we didn't do it sooner, because now I think that the market has built so much inventory up here that it's possible we have a top in for a really long time. The danger when you have a top in is that if prices can't go still higher, they go lower. I don't know how low we're going to go, if this is going to be a real serious bear market, which can, believe it or not, last 18 months to 2 years, or if this is going to be just a little bit of a reset and we're going to see still higher prices later on. I would really be hard-pressed to think that we're not going to see some type of a more sustained rally at some point. I don't necessarily know if that's going to happen tomorrow or next week, or how much more pain has to be endured first, but I do think that there is going to be some type of a counter-trend rally here to retest some of the damaged supports that will now presumably become resistance. Anyway, I think that covers a lot of what we really need to talk about. I'm curious to know what you guys' thoughts are with regard to the tape. So please be sure to tweet me. My handle is @JustinPulitzer. If you caught some of this video and you caught it a little bit late, I would say rewatch. You can catch the whole thing from the beginning. It's going to be on my YouTube channel. That channel is Justin Pulitzer Trades. I really appreciate you guys taking the time to tune in. I've been saying for a while that the way to trade the market is to do it with smaller position size, shorter time frames, and shorter expected swings. And I would say that really is going to be the key for the rest of the year in the market, and maybe even, believe it or not, some years to come. I want to just stress that this is a very quick market. There is a lot of volatility. Into the end of the week, the spiders are pricing in, still, believe it or not, a $10 move. I don't know if we're going to get another $10 in SPY. It had been pricing in about a $9 move for this week. The IV is really, really high. Just be very careful. You don't want to have oversized positions, particularly with margins. One of the biggest mistakes that people make, and I think this is really a lot for newer traders, is that you're always wanting to be max margin in your account, because you see if you're going to be losing money, right? You're going to be missing out on potential gains. But when the markets get into a downward move, the asymmetry of those moves can really cause some problems, and they'll cause some margin calls and forced selling. And that's a lot of, I think, what you're going to see today, the rest of the week, potentially, a lot of forced margin selling. That's why you want to be a little bit careful. I would say we're probably, I think you could buy some dips selectively, but I do believe that it's probably going to be a bit of a short the rallies type of a tape for at least for the foreseeable future. Anyhow, I will catch you guys later on in the week, and if you haven't seen the weekend video, please be sure to watch it. So let's have a good rest of the week. Please be careful. If you're not comfortable with this type of a market and you're seeing big losses, just sit out. It's better not to get your head handed to you and to get pasted than to try and force trade and trade locations. If you have a bunch of losing trades one after another, just stop. The capital preservation is important. Once the turn does come, at least you'll have a lot of cash in the market and be able to really take advantage of some of these bigger some of the bigger moves on the way back up. Some people are long only. I like to play both ways in the market. The last couple of years has been really just a long only type of a market because it's been kind of straight up. But let's just be careful. Yes, cash is a position. It's a very viable position, and it's one that will, it's better not to lose money. If you lose large percentages of your account, it takes a lot of gains to make them back. You don't want to really be more than 10 or 15% ever down at the most max, and that's even a lot. Once you start getting into like 30% and 40%, it's a really long trek back. Just don't do it. All right, guys, let's